Well, welcome. Those of you that have been here before, you know the drill. For those of you that are new to this is the drill. These are purely for your benefit. It is about education. It's about learning. There's not a product conversation. It's not a widget push. It's purely for your benefit. I will try and blend as much of your current benefit plan, namely your 401k plan, into this conversation as I can, because this is obviously a pretty hot topic always. But now that we've had this President Trump rally for the last 4 or 5 months, it really becomes a pretty important topic. And we had our second interest rate bump in just a couple months here with the interest rate bump yesterday. So it's very, very topical based upon present life situation. Based upon present life situation. So with that being said, as I go through this, I want to make sure that you're comfortable asking questions at any time, interrupt me and so forth. I'll make sure the material gets covered. I do tend to speak rather quickly from time to time, so if I gloss over something, you want a different analogy or better analogy, feel free to interrupt me. I've been doing the education here on site for probably 10 plus years now. My name is Paul Tourville. You've all got my contact information inside your folders. Some of you I know very well, some of you I haven't met yet, that's okay. So you've got the contact information inside the folders. Feel free to shoot me an email, give me a call at any time. In your folders, you've got a copy of every single slide that you're gonna see, partially as defense for me in case technology fails, but also partially for you in case you wanna take some notes or so forth. Hopefully you've got a pen that works as well. Also in your folders, you've got the homework packet. People always say, what do I have to put together if I want to sit down with you, Paul? So you've got the homework packet. That's the one that's got the investor profile questionnaire on the front, kind of a stapled packet for you. Similar to any financial advisor would give you. So if you're going to go to your financial advisor, this is the kind of stuff that you'd have to take to them anyway. So that's in there. There's a couple articles in there. One I'm going to reference as we go through this. One which is just great information on identity theft. It's become the number one fear for American consumers is identity theft, ahead of even terrorism. So it is important that you every single year pull that credit report. Make sure it says exactly what it should say, that it's actually talking about you. And you can do that free of charge through annualcreditreport.com. Our conversation today isn't about that, but because it's such a large concern, I want to make sure that that article is in there on identity theft. Then you've also got inside your packets the evaluation form. We picked these topics based upon your votes. So please do me a favor and complete the evaluation form, especially question 7. This is where the Chicago joke vote comes in. Vote early, vote often. Vote for all the categories that you want. We tally the votes up, get it back to Sarah, and that determines what our topic is. We've got these sessions today, which are on investing today, and then next Tuesday, we come back and talk about how to take care of mom and dad, which is a very poignant, specific topic. I understand that. But anybody that's in that situation or concerned about that situation, that's obviously a piece of education that's very, very, very valuable. So that's next Tuesday, how do I take care of mom and dad? But all the topics from that point forward, you guys pick. So please vote for question 7. What do you want to hear?
Can we have our kids come to the seminar?
Well, I should say. As far as I'm concerned, you can have anybody you want come to the conversation as long as they're polite. And if they bring snacks, that's even better. But yes, apparently on campus, yes, you can bring your kids to that presentation. How do I take care of mom and dad? That's right. Save and invest and work. And then any of you that want to talk individually, which most people do at the end of these things, to answer individual questions, maybe help with your 401k allocations, whatever it might be, more than willing to do that. There's not a cost or a fee associated with that ever with us. Just check the box. Tell me how to get in touch with you. We'll reach out to you, get in touch with you early next week, and then sit down and have a conversation or talk over the phone or whatever's easier for you. So we don't actively solicit employees. If you want to talk to us, that's great. Most people do. Just check the box, tell us how to get in touch, we'll reach out to you. So with that, let's kind of dive into this. We've got an agenda here. Some of the slides I put in there just as reference material. I'm not a big slide talker for those of you that haven't been here before, so I'll use some of them as reference. I want to hit some of the highlights, specifically when we talk about investing today. Where are we at in 2017? What's happened? And more importantly, what do we see for the balance of this year? So we do want to talk about savings versus investing. We want to talk on basics that are out there, some little bit about mutual funds, and then some of the guiding principles and strategies. But I do want to spend a fair amount of time talking about 2017. So saving versus investing, they're different purposes, right? Savings is money you gotta have. It has to be readily accessible, very liquid. That typically most of you see as money markets, checking accounts, CDs, saving accounts, things like that. Readily accessible type dollars. Versus investing, dollars you're putting aside. You're not planning on touching them immediately. They're there hopefully to earn you return. The trade-off is you take some risk with it, but obviously the benefit is hopefully you get better than a 0.001% return, like unfortunately most of us are seeing now on our checking accounts. So, investment basics, the categories for years and years and years. You've been very, very familiar with 3 of those, and that's stocks, bonds, and cash. Traditionally have dominated the retirement plans throughout this country, stocks, bonds, cash. This 4th category, alternatives, that you see there on the bottom is now starting to become more mainstream. Now, you do have an alternatives fund inside of your 401k, that PIMCO Commodity Real Return Fund. That is actually buying commodities, gold, silver, minerals, and things like that. It is not buying stocks, it's not buying bonds, it's not investing in cash. It is investing in gold and silver and minerals and stuff like that. We'll talk a little bit about that as we get to that section of it. So the alternative space is becoming more mainstream. It has been dominated for years by the big money. If you look at the endowments in this country, the charities in this country, last year over 52% of their investments are in alternatives. Only 31% in stocks, 16% in bonds, and 4% in cash. If I did those math correct on those numbers. But it's 52% have been in alternatives, only 30+% have been in stocks. So the alternative money has been a very dominant presence. A lot of us see alternative money as real estate. Now in Wisconsin, we tend to own the real estate, right? We buy it, we have the rental property, we have some maintenance involved in it, keeping it up and current and so forth, making sure the toilet works and the furnace works and things like that. But with some alternative investments, it would be very difficult. If you're buying gold bars, be very careful with who you tell where they are, right? If you're buying oil, you might eventually have a storage problem, correct? Your neighbors aren't going to be so keen on you throwing barrels of crude oil in your garage after a period of time, right? So there's some alternatives you can actually own the alternative investment, but some of them logically you're going to go into a pool like your PIMCO Commodity Real Return Fund does, where you're still buying gold, but you're not physically touching it. You're not physically touching the silver, the minerals. You're buying into a pool of it with other people, but you are buying an alternative. You're not buying a stock, you're not buying a bond. So, cash equivalents, most of you are very familiar with these terms. You know about them, you know how they work. It's all about preservation of principal. They feel awesome to buy. They should give you a big yellow fluffy duck when you buy them because they're so comfortable and cozy when you do. The unfortunate part is taxes and inflation matter, right? If it wasn't about taxes and inflation, would you ever take risk in your investments? No. I mean, do you like opening up your statement? Remember when the statements actually had negatives in front of them? Do you like opening it up and saying, oh, I lost money, great, well, it's part of the game? No, nobody likes that, right? The reality of the situation is if it wasn't about inflation and taxes, you wouldn't take any risk in your investments, right? You'd put all of your money in your Fidelity government money market option, your 401k, and let it sit. But unfortunately, if you do that on a long-term basis, that's not going to be good because inflation and taxes are going to put you behind. You're just going to have to save more and more and more to do that. So because of this right here, taxes and inflation, most of us take step into the investing world. The logical first step is into bonds. A bond is just a loan. You're lending money to somebody. You're lending money to a company. You're lending money to a government. We don't call them loans. Loans sound risky. We call them bonds. Whatever. It's the same thing. You're just lending money to somebody. The concept here is if I lend you money, you're going to pay me interest for the use of my money as long as you have it, and at the end, you're going to give me my money back, correct? The only risk is that you go out of business, you go out of country, and you don't pay me back. That's the risk. Call it default, call it bankruptcy, whatever the case would be, right? If things go bad, the first person getting the check is the bondholder. The people you owe money to is the first person getting the check. The last person getting the check after the taxes get paid and after the attorneys get paid is the person who actually owns that business. Who's left? Whatever's left, that's what they get. The stockholders are last. When you looked at General Motors, when General Motors went bankrupt, the senior secured bondholders, the guys that were first in line of the debt, they got every dollar back. Every dollar they lent, they got back and put it in their pocket. The regular bondholders that lent them money but weren't first in line, they got about 20 cents on the dollar back. So if they lent General Motors $10,000, they got about $2,000 back. But the stockholders, the guys that had General Motors stock in their hand, got nothing, zero. So bonds are more conservative than stocks because you're first in line if things go bad. You do not participate in the gains or losses of the business. Your only hope is to stay in business long enough to get your money back. All right. When you talk about bonds, they're issued in different maturities. It's just the different length of time you're lending money. Shorter term, 1 or 2 years. Medium term, intermediate term, 3 to 10 years. And then long term, 10 plus years. Different spaces. Obviously, if I'm lending money for you for 10 plus years, I've got a higher chance that you're not going to be around in 10 years, right? Therefore, my risk of you going bankrupt or defaulting is higher than if I only lend you money for a year. There's only so far you can go in a year, right? So typically, longer-term bonds are more aggressive than shorter-term bonds. When you talk about bonds, you have to have the conversation about interest rates, all right? The conversation about interest rates For a long time, we have been at very low interest rates. Now, very recently, post-election, we have seen a spike in those rates. When you take a look at this first graph, you might have to reference your page because I realize these are small. You take a look at this first graph, you talk about where are we at compared to the rest of the world. We have seen our interest rates move up. The risk that everybody talks about out there when you're lending money is a spike in rates. Rates just mushrooming up and just going up very, very quickly. Because the basic concept is simple, right? If interest rates go up, the price of your bonds is going to go down, right? It's the old teeter-totter analogy. Interest rates up, prices down. Well, if this happens fast, then this is going to happen fast. And when you own it and this happens fast, that doesn't feel very good, right? That hurts. That's a loss in your portfolio. So if you're going to do things like that, you have to be conscious of what you think is going to happen with interest rates. We do not see, most investment professionals do not see a risk in spike of rates. We think rates are going to continually, gradually rise like they did again yesterday, quarter point, right? But we don't see big spikes occurring in interest rates for these reasons. Top left here side, the blue line that you see, the top line that you see on your charts, that's our interest rate. That's the United States of America. The other ones, the red and green and yellow, the bottom lines that you see there, that's Japan, Germany, and Canada. That's the rest of the world. So what this graph is showing you is that our rates, even though they're low historically, we're still well above the rest of the world. We're still well above the rest of the world. And our rates can't go crazy, right? Otherwise, people would just invest elsewhere or they'll lend money elsewhere. Number 2 over there, the top right-hand side, the rise in interest rates regulates itself. See the bouncy, jagged line? They always kind of tend to adjust. We've had this little spike lately. Do you think that spike is going to shoot up to the top of that graph? Probably not, correct? That's not what history shows us. So more than likely, it may continue to float, but we don't see a continued spike in those rates. Number 3, demographics. We're getting older, right? That shows the actual percentage of the world population that's over the age of 55. That line is obviously going up. Boomers are now well into retirement, correct? Well, the fact of the matter is pretty simple. If I'm spending money, right? I'm probably borrowing money, credit cards, car loans, auto loans, and things like that. If I'm spending money, right, that's going to put upward pressure on interest rates, right? If I'm borrowing money, if there's 6 of us in line that want money from you, probably, logically, you can charge a higher rate of interest, correct? But if there's only 1 of me in line wanting money from you, well, you're not going to be able to charge me as high of interest, correct? So how does this work? Well, highly technical portion of the show. Retirement's broken into 3 phases. Really technical. Go, slow go, no go, right? That first 15 years or so of retirement, that's when you're taking all the trips, driving the RV all over the country, doing all the stuff you've always dreamt of doing, playing golf 6 days a week, spoiling the grandkids, blah, 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 whatever. You're doing all the stuff you've dreamt of doing. But then logically, when you reach phase 2 of retirement, 75 years of age, 80 years of age, you don't want to be driving the RV all over the country anymore. The grandkids were fun to spoil when they're 6, but now they're 26. You don't need that many jars of pickles in the basement, so you don't need the garden the size of Wyoming. The neighbors all have the quilts that you've knitted for them. They don't need more, right? So your spending is starting to slow. You're not using debt as much. You're not borrowing money to take those trips. You're not using your credit cards. You're not buying new cars all the time, right? Well, again, if I'm not putting the pressure, if there's not 6 of us in line waiting to borrow money, right? Interest rates will fall because there's not as much demand. As the world ages, that demand will start to slow down. It's logical. People just don't spend as much money when they're 80 or 85 as they did when they're 65. Make sense? And the last thing there, President Trump obviously ran a campaign, made a lot of promises and a lot of suggestions out there. More than likely, they're not all going to pass, right? So there's a lot of conversation. And the big reason for this spike in interest rates was there was a pervasive thought that we're going to see massive tax reform, and the tax bracket in this country is probably going to fall to about 25%. Now let me ask you a question. Do you honestly feel that the top income tax bracket in this country is going to go from 43, basically where it is now, 39.6 plus 3.8, to 25? Anybody see that happening? Right? Just more than likely not going to happen. Plus, you'd have to be above $467,000 of income to even be affected by that. Popular among the American consumer? No, because who makes more than $467,000? About 1% of the populace. So you're going to upset 99% to give a tax break to 1%? Probably not going to be very popular, right? Tough to get reelected. Congress needs to get reelected every 2 years, correct? president every 4, senators every 6. So it's very, very doubtful that we're going to see all of the policies implemented. We'll see some change, no question. I think healthcare is kind of here. We got this immigration thing here as well, right? You know, tax reform and things like that I think will happen, but I don't think we're going to see as broad of a change as was originally talked about during campaigns. So for those reasons, we don't think rates are going to spike. So what does all that mean to you? When you look at your 401k, if we think that rates aren't going to spike, I'm not so concerned about this happening with the value of your bond portfolios. So when you look at your list of bond portfolios you have in your 401k, you see the managed income portfolio, a very shorter term type interest rate portfolio, a very shorter term bond portfolio. You see the Baird Core Plus, you see the Fidelity US Bond Index, and you see the PIMCO Real Return. Well, the Baird Core Bond and the PIMCO Real Return are actively managed. They're being bought and sold by active managers every single day. If we're in a rising interest rate marketplace, would you rather be stale and sit, index, or would you rather be trading? Well, if you look at the performance of those funds, you just compare that Baird Core to the index, it's beaten the index pretty handily for the last 1, 3, 5, and 10 years. They're both options inside your plan. You might want to look at being more actively managed because interest rates are moving. And if interest rates are moving, don't you think your portfolio should be moving? When interest rates are static, buy the index, right? Who cares? But when interest rates are moving, you probably should be doing something. And you have those options inside your portfolio in that Baird Core Plus and the PIMCO Real Return inside the bonds. Questions on bonds? Let's move to stocks. Stocks, you now own part of the company, correct? So I always leave these slides in there just because I'm a farm kid and I like talking about this because most people don't know this. Why do they call it a bull market? Why a bull? Somebody has to know this. Really? Because when a bull attacks you, how does a bull attack you? It lowers its head and it raises up. Bull market, up. When a bear attacks you, how does a bear attack you? It rises up and strikes down. Bear down, bull up. It's not more complicated than that, folks. It's called the bull market because bulls attack by going up. The bear market because the bear attacks by driving down. And that's probably the only thing you might remember from this entire session, but it's kind of fun. It's good cocktail conversation for later today. All right, what do you do if the stock market drops? You go back to your disciplines, right? Why am I in this? Should I be in this? Is this a logical thing for me? It is tough to hang in there. It is tough. When your 401k is getting pounded, it is tough to say, hang in there, believe in America, it'll come back. Okay, dude, I'm down 50%. I don't know about hanging in there anymore with you because I'd like to retire someday, right? So it's tough. There are things you must do analytically to help you with that fear, that emotion. So that's what we want to focus on. 7 years or less, you might want to tweak that strategy, protect some of the bottom. 15 years or more, it goes through cycles, and that's kind of the way that it is. This chart is very, very, very important. I think it surprises a lot of people. I actually gave you an article. Should I wait for the market correction, right? Because I can still get people today telling me, I'm going to buy. I'm just going to wait till it sells off a little bit. Well, I got news for you. There's no flashing sign out there, It just doesn't happen. There's no sign of when to buy. This is the stock market since 1980. The S&P 500 since 1980. The gray bars, or the bars, represent where it finished the year. That's 36 years to the end of 2016. First off, in those 36 years, you have 6 that were negative. Of 36 years, 6 were negative. I really think it's due to turn around and go negative. How many times have I heard that? I've been in the business 25 years. I've heard that every single year. Every single year. There are some years where the market has finished negative, right? Most recently, the credit crisis of 2008. See that big negative there? That's the biggest negative we've had since the Great Depression. We lost 38% that year. Largest negative in history other than the Great Depression. We had the early 2000s. We had this little thing called Y2K when we thought we all had to buy new computers and everything was going to change and satellites were going to fall out of the sky and ATM cards weren't going to work, and then Happy New Year and they all still worked, right? So all those orders we had in for new computers and new technology, we said cancel, cancel. That whole technology bubble burst, right? It went away. And then you throw on top of that a terror attack of 9/11, 18 months later, and you have 3 consecutive years of negative returns. And you've got some other negatives kind of interspersed in there, right? We had our oil embargo. We used to have to stand in lines to buy gasoline. Some of you probably remember that in 1981. Carter's Misery Index, Reagan years and things like that. And of course we had 1987 in there, but it actually finished positive that year. So the point is, gray bars, where did the market finish the year? 30 of 36 years it has finished positive. Some barely positive and some hugely positive, but it has finished positive. You made money by staying in the markets. But equally as important part of this graph, which is also in this handout, like I said, the red dots represent where it was at the worst point of the year. Every year has a red dot. What that means is that every year, at some point during the year, the stock market was negative. Every year since 1980, at some point during the year, the stock market was negative. You open up your statement and went, ugh, I lost money. I hate this. It's going to explode. I'm selling. And then you looked where they finished, right? 1987. Dow fell 500 and some points in one day, right? 20% of the value gone, erased in one day. It would be like if the Dow fell, and I hope this doesn't happen, it would be like if the Dow fell 4,000 points today. It actually kind of hurts me to say that out loud, by the way. But anyway, right? Because my revenue is kind of tied to that, so I feed my family. So, but literally, that's how far it fell, 20% in one day. It was down 34% at one point during the year. It finished the year +2. You got paid to hang in there, right? Even these other years. Now, some of those swings are huge. You look at 2009. At one point during the year, March 9th of 2009, the market was down 28% for the year. Dow 6,600. It finished the year up 23. It's a 51% swing in 1 year. You got paid to hang in there. Can you imagine? Take your 401k, 51% gone and came all the way back in 1 year. Holy cow, right? Which is kind of why people put their head in the sand, right? So you get paid to hang in there, but you have to battle the emotion. You have to battle the fear. And the fear of going broke is a pretty powerful fear, right? So you need to do things to help you out with that. We're going to go through some of those. Alternatives I kind of addressed in the middle. It might be precious metals, gold and silver. It might be art. It might be real estate. You obviously understand the concept. Like I said before, you can own them individually, own the gold bars, own the silver bars, own the oil, storage problem, own the real estate, get called at 11 o'clock because the furnace is out, replace the carpeting, right? You understand that. Or you can buy into the funds. You have the PIMCO Commodity Real Return Fund. Now that fund is actively trading gold and silver and minerals. It is a fairly aggressive fund. So by no means take from this conversation I'm telling you to put 20 or 30% of your portfolio into that PIMCO Commodity Real Return Fund, but maybe you make a 5% play. If you're a moderate aggressive investor, maybe you make a 5% play in there or something like that. Because the proof is facts. Here we go. Here's 6 different portfolios. And I know I'm kind of blocking the screen, but I'm not Ronaldo Nehemiah. I can't quite jump these things. I'm dating myself again. Old hurdler from the 80s. Sorry. Anyway, so here you go. Here's a very conservative portfolio. 70% bond, 30% stock. We brought in 20% alternatives. So we cut the stocks down by 10. We cut the bonds down by 10. We brought in 20% alternatives. What we do, the bottom line is risk. So obviously this way is less risk. That way is more risk. This is return. So what do? We reduce the risk. We increase the return. A moderate portfolio, 50 stock, 50 bond. We bring in some alternatives, 40, 40, 10, or 40, 40, 20, right? Bring down the risk, pushed up the return. Here's an aggressive portfolio, 70% stock, 30% bond. Take off 10, now it's 60, 20, 20. Bring down the risk, increase the return. There's obviously a case for alternatives. The reality is you might have those more outside of your retirement plan than inside your retirement plan here. But as you look forward in the future, if you're still here at Alliance in 5 years, and I pray to God I still am too, you're probably going to see more alternative investments as part of your plans. It is moving across this country. You're a little bit ahead of the curve because you've got one, right? But you'll probably see some real estate funds and some other things like that into there. We got to get a little bit away from 2008 because that sting still hurts a lot of people, right? But you're going to see, obviously real estate values have moved, correct? Anybody know anything about lake property? Know anything about high-end condos? They clearly have moved considerably in value. And even all homes have definitely appreciated in value very recently, no question. The slide on the right, the reason I put that on there is that sometimes it matters who's managing your money. Sometimes it does. But a lot of times it just doesn't. You see these little dot things over here? This is large company core. So this is all of the large company core managers are out there. So this is Exxon, Apple, Caterpillar, Coca-Cola, Google, Visa, those types of companies. So these are managers that are making a decision, what do I buy today? Do I buy Exxon today? Do I buy Google today? Do I buy AT&T today? Do I buy Caterpillar, right? These are all the returns in that little tiny bar that's there. The dash is the average, but it's not very big, right? What does that tell you? It doesn't really matter who you're picking. You like Vanguard? Fine. You like Fidelity? Fine. You like T. Rowe Price? Fine. Whatever. There's really not a whole lot of difference in return. There's only one Exxon. There's only one Caterpillar. There's only one Apple. And they're all going to own it, right? They may own different percentages, but there's just not going to be a lot of difference. Same thing is true for bonds. Look how tight the bond space is. Low end, what, 4.7? High end, what, 4.9? There's not a lot of difference. There's just not. If you own them all, you own them all. No big deal. But when you go over here to alternatives, look how big those are. Look how wide those spaces are. So if you're not going to buy, my point here is if you're not going to buy the actual gold bar, you're not going to buy the real estate, you're not going to buy the oil barrel and store it in your garage. If you're going to hire a manager to make decisions on what to buy and sell, you better pick a good one. You got to do some due diligence. So you got to be involved in this process, or you got to have somebody that's involved in this process. It becomes very, very important what they're buying and selling. Okay, so track records, history become very, very important. You don't want the new 26-year-old who just graduated out of MIT that says, yeah, I can manage stocks, or I can manage gold for you. Okay, what do you know about gold? Because I remember gold fillings, and I know you don't even have one, because they don't use that anymore, right? So I know you're a smart kid, but let's see some history here, all right? So it is important when you are looking at alternatives. There's a valid case to use them. Like I said, it's probably in your case more going to be outside of your retirement plan than inside your retirement plan. But do some due diligence. Make sure you really know who you're investing that money with, as far as they're still going to buy the same thing, but the knowledge of what they're buying and what they're selling becomes very, very important. Major asset classes, the bottom one basically shows inflation versus bonds versus stocks. And clearly you get rewarded higher for stocks and bonds and more than bonds and in cash. And yeah, I think you understand that. But the top one is the one I really wanted to leave on there. That is the S&P 500. Starting in 1970, $10,000, left it alone. By the end of last year, it was worth $250,000. So 10 grand became $250,000, 25 times the return over those 46 years. But that's the index. If you throw dividend reinvestments in, right? You throw dividends reinvestments in. Now these are companies that aren't trying to grow in size. ExxonMobil, not going to get much bigger, right? Why do you buy ExxonMobil? Dividend, profit check, right? The power company. Think the power company is going to get a lot bigger? No. Why do you buy stock in that company? Dividend, profit check. Hugely important. Look at the return difference. It's 4 times the return by just reinvesting those dividends. So, if you think the market's going to be relatively flat, or you think you're going to be a long-term investor, you probably need to pay attention to dividends. Well, how do you do that in your retirement plan? You have the Columbia Dividend Income Fund, correct? So what is Columbia Dividend Income buying? Dividend-producing stocks. Does Google pay a dividend? No, right? They use their cash to do other things. Does Apple pay a dividend? No. They use their cash to do other things. But does Caterpillar? Absolutely. Does AT&T? Absolutely. A big one too, right? I see the head nodding right up here. What'd you say? 4%. 4%, that's right. And it was over 8% for a period last year. That's free money. Company has to do nothing. You get your check. You put 4, 5, 6% in the bank for doing nothing with no move in the stock price. That's a good thing, right?
As interest rates rise, though,
Yep.
do you think the multiples will stay the same on those companies?
Multiples.
Because I noticed the multiples are pretty high in a lot of utilities and that, because there is no other place for people who want income to put their money.
That's exactly the point. You answered the question at the very end of the question, and that is this. For years and years, the thought was, well, are dividends rates going to rise as interest rates rise? Because it becomes a competition, right? I can take my $10,000 and I can loan it to the United States government, and they're going to pay me 3.7% interest on that $10,000. Or I could take my $10,000 and buy AT&T stock. And even if AT&T stock does nothing, I buy it, does nothing. Stock price doesn't change. But they pay me a 3.7% dividend. Both of them paid me 3.7, right? Which business model do you like better? Don't answer that question. It's being recorded, right? But they're both going to pay you the same. So then the pervasive thought is, well, if interest rates rise, what happens to dividends? But the reality is exactly what you said at the end of the sentence. If you looked 6 years ago, we had over 8,000 publicly traded companies. If you look today, we barely have 5,000. Supply and demand. There's just not as much to buy. Because as companies have done well, what do? They buy their competitors. They buy their smaller companies, or they buy themselves back and go private. There just isn't as many stocks to buy. The Dow Jones is higher, no question. There just isn't as much to buy. So you want to go out and buy that utility. Power, I get it. It's going to be here forever. It's not like we're turning the lights off in America, right? The solar thing sounds cute. We can't replicate it. Wind, I get it. Lots of wind turbines around here. Not really doing anything, right? So we're going to have power companies. I get it, okay? And they're going to pay me a yield. They're going to pay me a dividend. I get it. I want to buy some. Well, now there's only 6 to pick from. So what do you think is going to happen to the price of those 6? Supply and demand, right? There's less to buy. If I got 20 to buy, maybe I buy these. If I got 6 to buy, right? Competition, that's just the way it is. So I think you really see multiples going up, right? Because it's just competition. There's just not as many things to buy. There's just not.
Their dividends would have to rise.
Yep.
You're not going to risk your money. If you could get, if interest rates were to return to 5%,
Yeah.
you aren't going to buy this company that's only paying about 5% because there's a risk involved.
Right. But do they need to borrow the money is the problem. Do they need to go and borrow? I mean, Apple Computer's got, what, $160 billion in their checking account right now? Do they need your money? You know? If interest rates go up to 5%, you think Apple's going to pay you 5? Really? They got $160 billion in the checking account. That's bigger than almost every other company out there. Total. They got more cash than Coca-Cola's worth. Period. Yeah. So, all right. So dividends matter. Mutual funds, most of you choose to use mutual funds. It's essentially interest diversification, right? You put your money in the Columbia Dividend Income. That Columbia Dividend Income is like a big shopping cart. It has all the different dividend-paying stocks inside of there. You don't have to use a mutual fund. In your outside money, you could buy individual stocks, but then you got to make decisions on what you're going to buy. Challenging. Do you have enough to diversify, right? So most of us are going to use mutual funds. Hopefully we got somebody professional managing that fund. Hopefully a Columbia or Vanguard or T. Rowe or Fidelity know what they're doing. We get some diversification, and obviously I can get my cash back if I need it. 4 types of mutual funds, pretty well represented in your 401k. I don't think I'm adding a lot of value there. Active versus passive. The passive managers are the indexes. Of course, the biggest name you recognize there is Vanguard, right? When the markets are running forward like they have been the last 4 or 5 months, everybody in the world, including us, loves indexes. Why? They're cheap. I don't have to pay much, and I get all the return. That's awesome. Unfortunately, markets don't always go up. And when markets start to go down or level, then this passive style or this active style kind of jumps up then. Then you're looking for saying, hey, can you help me out managing this? That goes back to the conversation I had about bonds, right? If bonds are moving, do you think your manager should be able to move? That's why I was saying look more Baird, look more PIMCO real return. If interest rates are flat, more passive, maybe you use that index fund, right? Same thing with stocks. So what do you think is going to happen with stocks? Do you think we're just going to keep on doing this? If you do, you're going to love indexes, right? But if you don't think this is going to continue for some reason, if you think we might do some of this for a while, maybe you have to look more active. Value versus growth. We'll let you touch on that. So guiding principles and so forth, rebalancing portfolios. I think there's things you need to do at the end of every single year. One of them I mentioned already, and that is double check your credit report, pull that credit report. I think another one you need to do is make good benefit selections. Make sure that you take advantage of all the benefit plans you have here at Alliance. The average American still spends barely 11 minutes picking their benefits. 9 hours Christmas shopping. Probably should be closer together than that, especially if benefits are 30 to 40% of your compensation and the kids play with the box more than the toy anyway. So you got to make good benefit selections. You got to double check your beneficiaries, make sure your beneficiary arrangements are accurate. I know you put it in the computer 3 years ago, double check it. Things get lost, things change, you forget who you put in, that kind of stuff. But you also need to rebalance your portfolios. Sell winners to buy losers, losers become winners, and winners become losers. You need to rebalance those portfolios. It's how you prevent yourself from getting hurt. The fact of dollars saved and so forth, we'll let you read through that stuff. Here's the last slide I want to hit on investments. So the top squiggly lines represent the blue line on top, the top line here, represent a portfolio that's 40% invested in stocks, 60% invested in bonds. This chart starts October of 2007, peak of the market, the previous peak of the market, October 2007. It goes all the way through the end of last year. The middle line represents the reverse, 60% stock, 40% bond. So the top one is 40 stock, 60 bond, a conservative portfolio. The second one is 60 stock, 40 bond, a moderate portfolio, right? We're going up the scale. The bottom line, this greenish colored line here, the bottom line on your charts, that's 100% stock. That's clearly an aggressive portfolio, right? The point is this. They started October of 07 and they finished December of 16 in about the same spot. But the ride to get there is really different. Here's where discipline helps you, right? It's sexy to say I got it all in stocks, I'm aggressive and I'm risky. But it's really hard when you get pasted and you're down $50,000 on a $100,000 portfolio. It's really hard to hang in there, right? When you're down 50 grand, you're down half of your account is gone. Hang in there, believe in America, it'll come back. Listen, wait a second, I'm getting smoked. I'm going to run away, right? You can run away. The problem is when do you come back? And that's what's happened in America. We, American consumers, haven't come back. That's why there's trillions of dollars sitting on the sidelines. Because we remember getting stung. I'm not doing that again. Inflation and taxes are there. They're going to be here forever. You can't get away from that. You can't beat it by being in money markets and CDs and cash. You can't. So how do I stay invested? How do I hang in there? Well, here's a 60-40 portfolio. It's the middle line. You're still a moderate investor, right? You put in 100, it went down to 80. You lost 20% of your 401k. Oh, man, does that hurt? Can you hang in there? Oh, it's not fun, but I mean, I'm down 20. I don't enjoy that, but you know, I knew coming into this thing I could get hurt. But you're probably going to hang in there, right? Your chances of hanging in there are much easier, right? Or if you're a more conservative investor, you went from 100 down to about 90. You lost 10%, down to 90,000. Ooh, that didn't feel good. But, you know, I'm going to hang in there, right? It's easier to hang in there if you don't get pasted as hard, right? If you don't get hit for 50% of your account, it's easier to hang in there. Look at the ride back, right? Because here's the point. The second highest box here, the first one, by the way, is real estate, right? Had a little run in real estate since about them. Here's the stock market, 100% S&P 500, 8.2% returns. 60-40 portfolio, 60 stock, 40 bond, 7.2. It's only a 1% difference. But I would submit to you it's a lot easier to hang in there when your max sell-off was 20% versus 50%. Easier to hang in there. Which is good, because you know what happens when people are down 50%? They sell, right? They say, I'm getting out of this thing, which is why the average investor, the average one of you and I in this country, since the peak of the market, October of 07 to the end of last year, did that, 2.1%. That's what the average person in this country did in rate of return. Because it's tough to hang in there. You must do things analytically to help your emotion. The emotion is fear. It causes you to sell. A balanced portfolio started and ended in the same place, but the dip wasn't near as bad. It's easier to hang in there. And the return, 1%, versus being behind even inflation, right? Do things analytically. Rebalance portfolios. Now versus the future, time horizons. So you have a risk assessment questionnaire in there. Obviously, any financial advisor in the world, if you go on your website, you'll have a risk assessment questionnaire in there. Commercials for why that's necessary. Here's the asset allocation portfolio kind of in the middle. Rolling hills, right? No peaks and valleys. No peaks and valleys, right? Don't pick your investments by, what did it do? Ooh, this really did well. Yeah, it did well. That doesn't mean it's going to do well, right? You're going in today. It did well. That was back then. That helped out those people, not you. So asset allocation, rolling peaks and valleys. You're still going to have peaks and valleys, but you're trying to avoid cliffs and plunging off, all right? So you build your portfolios that determines your risk tolerance and so forth. talks about staying in the market. Here's what a lot of us do, and we're seeing this right now in this country. Market got hammered in '08. A lot of us ran the sidelines, and the American consumer is just barely starting to talk about getting back in. The Dow was 6,600. It's 21,000, right? 8 years later. And most of us sat on the sidelines. Most of us missed it all. Because we do this. Market's coming back. Things are going well. All right, it's back where it was. Okay. All right, I'm in. Oh, wasn't that smart? Oh, it'll come back. I believe in it. Well, I hope it's going to turn around. Well, I really want to stay. Okay, I'm out. Right? Most of us do that. We let our emotions run the table, and we buy high and we sell low. Not what we want to be doing. So how do you fix that? Number one, probably a lot of you are unconsciously already doing this, and that is through your 401k, your dollar cost averaging. You're putting money aside every single paycheck. Thankfully, they don't send you an email. Hey, we've got the $200 we withheld from your check this week. Do you want us to invest it today or not? Can you imagine if we got an email every week? Well, do I invest it? Don't I invest it? What do I do? I mean, we just wouldn't, right? But you're helping yourself by just plunking it in. When the market's on sale, you buy more shares. It obviously brings down your price. Set it and then readjust it. Rebalance that portfolio once a year. Make sure, if you looked at your portfolio in 2009 and it was 60 stock, 40 bond, and you didn't do a thing to it, and you look at it today, I'll bet you it's 85% stock. Not because bonds have performed poorly, but stocks have really done well the last 7 years. Well, if the market tips over again, how do you think that feels if you're 90% stock or 85% stock? It doesn't feel good, right? You're going to give back a huge chunk of what you just made in the last 7 years. So, hey, I'm making money, why would I sell? Because winners become losers and losers become winners, and it's tough to hang in there when you're getting pasted. So, rebalance portfolios, stick to the discipline. The discipline will help the emotion. So, in summary, reviewing the monitor the goals, diversification, don't try to pick the market. If you can do that, you probably work for the wrong company. You probably should go to New York. Invest regularly, systematically putting dollars in, staying focused, regular monitoring the progress, and rebalance the portfolios. Rebalance those portfolios on a regular basis. With that, if you do want to sit down individually, you obviously have the opportunity to do that. There's not a cost or fee like I talked about. You've got a homework packet inside of there, and obviously we put together all kinds of projections and so forth to help people have confidence to retire. Not necessarily retire, but at least have the confidence where if they want to retire, they can. And that's why you're doing this, right? Do me a favor, please fill out the evaluation form. Tell me what you like and what you don't like about this. Vote, question 7, vote early, vote often. Vote for all the categories that you want. I appreciate you being here. Go Ripon, why not? Want to bring home a state title? That'd be kind of cool. I was born and raised in a very small town. It'd be pretty cool. I never got to the state championship game, but thanks for being here. I appreciate it. Do me a favor, fill out the evaluation forms, and I've got time for questions if any of you have questions. Thank you.